Welcome back. So, today I propose to take up the concept of interest rate risk, the measures of interest rate risk and the management of interest rate risk. Before I come back to that, a brief touch up on what we did in the last lecture, a recap. Towards the end of the last lecture, I was discussing the issue of the clean price and the dirty price of a bond transaction. To understand what exactly we mean by these terms, let us look at a transaction, that is a purchase or a sale of a bond which takes place between two coupon dates. So far we have been focusing our attention to transactions that are taking place on the coupon date, and as a result of which we have a whole number of periods to deal with. Now, let us relax that assumption and let us look at a transaction which takes place in between two coupon dates. Let us say the last coupon payment was at A and the next coupon payment is at B. So, this would be 6 months in a 6 monthly bond and 1 year in an annual bond and so on. And let us assume that a transaction takes place, a buy sell transaction takes place, a party X sells a bond to another party Y, say at some point in at C in between A and B. So, then the issue arises how to account for the interest that is attributable to the period AC and the period BC or CB. So, it is very clear that because the party X who is selling the bond has held the bond for a part of this coupon period, part of the period AB, that is the period AC, he should be given or he should be allowed the interest for that particular period. And as far as the buyer of the bond is concerned, the party Y, he should be getting the interest for the period pertaining to his holding of the bond, that is the period CB. And therefore, we work out or we allocate the interest which is called the accrued interest. We work out the accrued interest for the period AC, and when the price or the transaction price of the bond is arrived at, the interest for the or the accrued interest for the period AC is added to the quoted price to arrive at the actual cash price or the actual payment that A would receive, that X would receive, I am sorry, from the party Y. Let me clarify once again, this is an important concept, because X is you see, because X has held the bond for a part of that coupon period and Y has held the bond for the other part of the coupon period, the interest for the period A B needs to be allocated between these two holding periods. And of course, when Y buys the bond, he will approach the company and get the bond transferred in his name, and as a result of which, when the next coupon payment arises, that is at the point B, the entire coupon would be paid to the party Y. The company will not split up the interest and give part of the interest to X and part of the interest to Y. It will make the entire coupon payment to the party whose name appears in the register of bondholders, and that would be party Y, because he has bought the bond and got the bond transferred in his name in the company's records. So, in other words, the interest for the period AB gets split up into two parts. The interest that is earned by the seller for the period that he holds the bond, and the interest for the period with the buyer holds the bond. Because the entire payment of interest is going to be paid to the buyer of the bond on the next coupon date, which includes the interest for the period which the bond is held by the seller, the buyer needs to compensate the seller for the interest pertaining to the period that the seller has held the bond. This part is called accrued interest. So, in other words, the actual transaction price of the bond will comprise of two parts, the quoted price of the bond plus the amount of accrued interest, that is the amount of interest that has accrued on the bond from the date of the last coupon payment to the point at which the settlement is made or the trade between X and Y is settled by the relevant exchange. So, in other words, and the total price of the bond, that is the transaction price, is called the dirty price of the bond, and the clean price of the bond is the price at which the bond is quoted. So, let us repeat the definition of accrued interest formally. the amount earned by the seller is the interest that has accrued between the last coupon date, the last coupon payment date and the settlement date. This interest is called the accrued interest, and because the buyer is going to be recouped or replenished with this amount of interest as well as the interest for the holding period, because the company will pay the interest for the entire coupon period. It will not, I repeat, it will not split up the interest and pay part of it to the seller and part of it to the buyer. That will not happen. The entire coupon payment will be made to the buyer whose name appears in the register of bondholders, and as a result of which it is the obligation of the buyer to reimburse the interest for the period of the holding of the bond by the seller, and that is called the accrued interest. So, at the time of purchase, the buyer must compensate the seller for the accrued interest, and the buyer recovers the accrued interest from the company at the next coupon date. Let us take an example to illustrate what I have been saying. Suppose that it is March 5, 2021 and the bond under consideration is an 11% coupon bond maturing on July 10, 2025 with a quoted price of 95.50. This is the clean price of the bond. Coupons are paid semi-annually and the last coupon and the final coupon is at maturity, that is on July 10, 2025. The most recent coupon date is January 10, 2021 and the next coupon date is July 10, 2021. It is also given that the interval between January 10, 2021 and July 10, 2021 is equal to 181 days. Assume that the interval between January 10 and March 5, 2021 is 54 days. Calculate the dirty price and the accrued interest. The clean price obviously is given to us, that is the quote at which the bond is quoting, which is 95.50. So, the total days between January 10 and March 5, which is the holding period of the seller, which is the part of the coupon period which is held by the seller, is given as 54 days and the total days in the coupon period are given as 181 days. Both these figures are explicitly given in the problem. So, we do not have to work out the number of days, and the coupon payment for the semi-annual period of 181 days, that is from January 10, 2021 to July 10, 2021 is half of the coupon rate. The coupon rate is 11%. Therefore, the amount of interest for this period on a 100 rupee face value of bond is equal to 5.50. Now, using the actual upon actual convention, we allocate the proportion of interest out of this 5.50 to the selling party as 54 divided by 181 into 5.50, and of course, the buying party would get the remaining of interest, which would be 181 minus 54 divided by 181, but we are concerned with the seller's stake, because the seller is to be reimbursed by the buyer and the company will reimburse the buyer. So, that is the process, that is the flow, and the amount that comes out to be 5.50 into 54 divided by 181 is equal to 1.64. Therefore, the settlement price of the bond, or the price at which the bond would be transacted, the cash received by the seller of the bond would comprise of the quoted price, which is 95.50, and the accrued interest, which is 1.64. So, the dirty price of the bond turns out to be 97.14. So, it is quite simple, but a bit technical, and this is the convention that is usually followed in the bond market. Now, a word about the DCF based price, the full price, which is also termed as the full price. Now, when the price of a bond is quoted using the present value calculations, it is computed with accrued interest embedded in the price. The price is referred to as the full price. Let us try to understand this with an example. Let us consider a bond which has a face value of 1000, the coupon rate is 10% payable annually. The required rate of return on this bond is the market rate, that is given as 12%, and the next and last coupon payment on this bond is on 31/12/2021. So, the final payment would be how much? It would be the redemption of principal, which is assumed at par to be 1000, and the last coupon payment of 100, that is 10% of 1000. So, the total payment would be 1100 as on 31/12/2021. Naturally, the bond if valued as on this date, that is 31/12/2021, it would be worth 1100. And let us now look at the valuation at earlier dates. If we value this bond on the 1st of January 2021 using the required rate of return of 12% and the final cash flow of 1100, we get a value of 982.1429. If we value the same bond at 1st April of this year, that is 2021, we get a value of 1010.367, and if we do the same valuation on 1st of October, we get a value of 1069.2722. Now, the important thing is you clearly find that the value is increasing. Why is the value increasing in this particular case at this? We had discussed it some time back that as the maturity of the bond approaches, the value of the bond must approach the par value of the bond. Of course, if there is a coupon, that coupon also has to be accounted for. Now, in this case, again we are finding this, the bond is quoted at a discount, and gradually as the maturity of the bond is approaching, the value is increasing. But we need to address a different issue here. What we find is that the amount that is being discounted, I repeat, the amount that is being discounted, that is 1100, is remaining constant irrespective of the point at which the valuation is done. However, as we do the valuation later and later, we come closer to the cash flow that is likely to occur, and as a result of which the discounting impact is reduced. The closer we are to the point at which a particular cash flow is likely to occur, the lesser is the impact of discounting. If you discount a cash flow way distant into the future, you will get a very small value. If you discount the same cash flow very close to the date of occurrence of that cash flow, you will get a value which is very close to that cash flow. That is natural because the discounting period gets reduced irrespective of the rate of interest, provided it is positive. Now, so that is the important point. While the coupon payment remains the same, remains constant, as we approach that coupon payment, the discounting process results in a lower results in a multiple which is closer to 1, and as a result the discounting effect is reduced as we approach the approach of the coupon payment. But the important thing here is that the coupon itself is not proportionately reduced. For example, it is not the case that when we are discounting the bond on 1st January 2021, we obviously use the full year's coupon payment, but when we discount the bond on 1/4/2021, that is on 1st April, we do not reduce the coupon payment. We are still discounting the same coupon payment of 100. However, because we have now moved forward in time, we are closer to that coupon payment, therefore, the discounting effect is reduced, as you can see from the figures that we have obtained. So, that is the important point. The cash flow that is discounted includes the full coupon amount irrespective of the date of discounting. That is the important part. The coupon amount is not proportionately reduced. The time goes on reducing, the time to the coupon payment goes on reducing, but the amount of the coupon does not get reduced. In other words, while the date of the coupon payment becomes closer, the amount discounted remains the same. It is not reduced by the period that has elapsed. Thus, the price includes the accrued interest for the period since the last coupon date. Because the coupon payment is not reduced, now the important part is because the coupon payment is not reduced, the coupon is discounted at its full value, the amount that is discounted at its full value. Therefore, the price that we arrived at includes the accrued interest for the period which has elapsed since the last coupon date. This is the example that I have alluded to just now. The coupon is not proportionately reduced. Let me reiterate this statement. Now, therefore, the full price of the bond as per the cash flow discounting formula, say DCF formula, is given by the formula that is here on your slide that I am underlining. This is the particular formula that is used to work out the discounted cash flow formula or the full price of a bond. Now, please note this point. expression within the square brackets is the value of the bond as on the next coupon date immediately before the coupon payment is made. Why that is so? Because of the presence of this factor C in the calculation of the price. Therefore, I repeat, the value that is arrived at in the expression in the square brackets is equal to the value of the bond immediately before the next coupon payment, and this value is then discounted back for the period which is remaining to the next coupon payment by the factor that appears before the brackets, which now I have encircled in the round brackets. So, this factor that appears as a pre-factor to the expression in the square brackets does the job of discounting the price or the DCF value as on the date of the next coupon payment to the date on which the valuation is done. But again I reiterate, the full coupon payment is being discounted. The C is the full coupon payment or the coupon payment relating to the full period since the last coupon date. The coupon payment that relates to the full period since the last coupon date, although the discounting is done for the period up to which the transaction is done, or at the point at which the value is calculated. So, that reiterates the example that we discussed just now, that while the coupon payment is for the full period, the discounting is for a period which is lesser than the full period if the point of discounting is in between two coupon periods, and as a result of which the price that we arrive at includes the accrued interest for the period for which has elapsed since the last coupon date. Now, we come to a very interesting and a very intriguing topic, which is usually dealt marginally in books on security analysis and portfolio management, and therefore, I propose to deal with it in some detail to make this course worthwhile. We will talk in detail about the concept of interest rate risk. We will talk first of all the concept of interest rate risk, then we will move to measures of interest rate risk, and then we will end up with the management of interest rate risk. So, let us start. Now, let me illustrate this, or let me get into this concept by virtue of an example. As I discussed in a lot of detail when we talked about the yield to maturity, one of the fundamental assumptions is that the holding period equals the maturity of the bond. The implication of this particular assumption is that we end up with a value of the bond on the date of maturity, which is predefined, which is specified in the contract of issue, in the bond issue document, and as a result of it there is no impact of the market as far as the value of the bond on the date of maturity is concerned. And therefore, when we work out the YTM, we are not concerned with the market value of the bond on the date the holding period expires. So, let us now relax this assumption. We briefly touched on this. Let us say the holding period of an investor is less than the maturity of the bond. Let us say the maturity of the bond is 5 years and the holding period of the investor is 2 years or 2 years say. Now, what happens? What will happen is that at the end of 2 years the investor has to go to the market and liquidate the investment by selling it in the market to exit the investment. Now, obviously, this has to be done at the then prevailing market price. Keep this at the backdrop of your mind. Now, suppose after you enter into an investment, after you take a position, after you buy a bond in the market, the interest rates, the market interest rates change. Let us say the market interest rates go up. Now, what would be the impact as far as you are concerned, assuming that you have a holding period of 2 years and not of 5 years, which is the life of the bond. Now, because the interest rates have increased, the coupon that you will get at t equal to 1, that is at the end of the first year, you will be able to reinvest that coupon at a higher rate, because the market interest rates have increased. So, the reinvestment income that you will get at the end of your holding period, the amount that you will get out of the reinvested coupon that you invest at t equal to 1 for 1 year to receive the proceeds at the end of the second year would be more. But what about the price? Now, if you liquidate the investment, if you liquidate the bond at t equal to 2 years, then the price that the bond would fetch would be such that the buyer of the bond gets a YTM equal to the new market interest rate, which is higher. Let me repeat this very important point. The price that you would get by liquidating your investment, by exiting your investment, by selling the bond in the market would be the price at which the buyer of the bond, the person who would buy the bond from you, would get return or would get a YTM based on this new price, which would be equal to the new market interest rate, that is the increased market interest rates. As a result of which, what will happen? The market price that you would get on liquidating the bond would be lower, and therefore, the capital gains, had you anticipated any capital gains, would have decreased. So, therefore, there would be two factors or two impacts on your return on holding the investment for a period which is not equal to the date of maturity of the bond. First of all, if the interest rates increase, the reinvestment income will increase. This is called the and if the interest rate decrease, the reinvestment income will decrease. This part is called the reinvestment risk or the reinvestment rate risk. If there is an increase in the market interest rates, your reinvestment income increases, and if there is a decrease, your reinvestment income decreases. In other words, your reinvestment income is a function of the market interest rates. This and would fluctuate depending on the market interest rates that prevail during the period of your holding. So, this risk or the impact of this fluctuation on your return is termed as the reinvestment rate risk. The second part is the capital gains. If there is an increase in market interest rates, as I explained just now, the market price of the bond at your point of liquidation would decrease, and conversely, if there is a decrease in the market interest rates, the market price at which you liquidate the bond would increase. Again, the capital gains that you get, the return on account of capital gains that you get on the date of maturity, I am sorry, on the date of your end of your holding period would be dependent on the market interest rates and would fluctuate in line in tandem with the change in the market interest rates. In other words, any market interest rates would impact your returns on two counts. Number one, the reinvestment income, which is called the reinvestment rate risk, and it would also impact the capital gains, which is called the interest rate risk. So, reinvestment rate risk and interest rate risk both relate to fluctuations in the market interest rates on account of holding a bond for a period which is less than, which is shorter than the maturity of the bond. Now, let us look at this diagram. We have seen it earlier. This is a diagram which depicts the price of the bond as a function of the YTM. I repeat, it is a yield price curve. In other words, it depicts the price of the bond at various values of YTM. The price of the bond is plotted along the y axis, the YTM of the bond is plotted along the x axis. And as now one thing is very obvious, the red curve is the relevant curve. As the bond as the YTM increases, and we also know that YTM is a proxy or an approximation of the or an averaging of the market interest rates. So, as the market interest rates increase or the YTM increases, the price of the bond decreases. This is very much apparent. This is also clear that if you look at the slopes of the curve at the point P and Q, both of them are negative. dP by dy are both negative, and as a result of which we again infer that price and YTM are inversely related. Howsoever you may like to infer, the diagram itself is depicting that the YTM and price are inversely related. We will come to a quantification of that in a minute. So, that is the first inference, that the slope is negative. The slope of the yield price curve is negative. Now, if you look at the slope at the point P and compare it with the slope of the curve at the point Q, you find that the curve has flattened out. What does it mean? It means that the magnitude of the slope has decreased. Now, I repeat, I have used the word magnitude. So, because the slope is negative and the magnitude of the slope has decreased as we move from the point P to the point Q. In other words, as the YTM increases, what we infer is that the slope has actually increased. decrease of a negative quantity means it has actually increased. So, as we move from the point P to the point Q, that is the YTM increases, the slope of the slope is positive, or the second derivative is positive. So, we arrive at two conclusions. Number one, the slope or the first derivative of the yield price curve is negative, the second derivative or the slope of the slope is positive. Let us now move to the next slide. Now, this is the quantification of the results that I have just mentioned. You start with the for expression for the intrinsic value or the market price in terms of the YTM. P 0 is equal to summation T equal to 1 to capital T. Capital T is the maturity of the bond as usual, C T upon 1 plus y to the power T. If you differentiate this expression with respect to y, keeping C T as constant, because it is given in the contract of issue, we have discussed that. What we end up with the second equation, let me call it equation 2, let me call this equation 1. So, if we look at equation 2, we find that this is clearly negative for all values of y greater than 0, and for obviously t has to be greater than 0, and in fact, the summation is from 1 to capital T. So, it is always positive. The cash flows, we are assuming as usual that the bond follows a conventional cash flow stream, that is the first negative cash flow, which is equal to the price at which the investor enters the investment, and followed by a stream of positive cash flows. So, we clearly find that the first derivative is negative as explained on the basis of the figure that we just saw. We also find that the second derivative turns out to be positive. Again, this is a straightforward differentiation with respect to y, and we find that this second derivative turns out to be positive for all values of positive y, t, and the given conventional set of cash flows. So, the results that we arrived at on the basis of a perusal of the figure that we have here are vindicated by explicit mathematical calculations. I repeat, the slope is negative, the second derivative is positive, the slope is increasing because it is negative and it is decreasing in magnitude. And so, these are the conclusions. I reiterated the conclusions in this slide, what I have explained in the last few minutes. What is the impact of convexity? Now, that is very interesting. Look at the figure that is on the right hand side of your slide. What we find is, let us say this is my central point y 0, or let me come to this is a central point, let me say this is y 0, and a small change in the value of y 0 occurs by a value of delta y, and we have another value of delta y, which is y 0 plus delta y, and this is the case situation where the value of y 0 increases by a small amount of delta y. Let us now look at the other side, and let us assume that the value of y 0 decreases by the same amount delta y. So, we have this point y 0 minus delta y. Now, the corresponding values of the price, let us write them as p of y 0, that this be p of y 0 plus delta y, and let us write this as p of y 0 minus delta y. Now, in line with the fact that the YTMs and prices are inversely related, it is quite clear that p of y 0 minus delta y would be greater than p of y 0 would be greater than p of y 0 plus delta y. But there is another interesting observation. If you compare the difference between p of y 0 minus delta y and p of y 0 and the difference between the value of p of y 0 and p of y 0 minus delta y, you find that the former is significantly larger. This accounts for, or this is attributed to, this arises from the convexity of the yield price curve, that is the property that the second derivative is positive. So, what do we conclude? For a given decrease in yield, delta y, the percentage price increase is greater than the percentage price decrease for an equal increase in yield. In other words, p of y0 minus delta y minus p y0 is greater than p of y0 minus p of y0 plus delta y. So, that and this is attributed to the reason that the yield price curve is convex towards the origin, which is explained by the fact that the first derivative is negative and the second derivative is positive. Now, we come to the measures of interest rate risk. Now, there are 4 common measures of interest rate risk, and they are dollar value per basis point, which we abbreviate as DV01. The second measure of interest rate risk is Macaulay's duration and convexity. The third is modified duration, and the fourth is interest rate elasticity. We take each of them in detail. As far as the dollar value per basis point is concerned, it is quite simple. Dollar value per basis point DV01 is the change in the bond price corresponding to a change of 1 basis point in the yield. I repeat, it is a very simple straightforward definition. Dollar value per basis point DV01 is the change in the bond price corresponding to a change of 1 basis point in the yield. This is given by the negative slope of the yield price curve. Now, please note this important point. We by convention and not by any mathematical rigor, we use a convention of a negative sign in front of the derivative. That is the reason for this is that we want to return a positive number. The relationship between the yield and the price of a bond is invariably negative, is invariably inverse, and as a result of which the derivative dp by dy would always be negative. But for convenience and for convention's sake, we prefer a positive number, and as a result of which we introduce a negative sign in the very definition itself. So, dv01 will be returning a positive number, and we must understand that there would be a decrease in price corresponding to an increase in YTM. That would invariably be so for a level coupon bonds with conventional cash flows. Now, we come to the concept of duration. Now, that is the most important concept here. I will explain this in detail after the break. Thank you.